According to Vanguard, about 80% of Americans over 60 own a home, and about half of our net worth is tied up in that house. So the good news is we have home equity. The bad news is there's a hidden tax that's trapping most of us in our homes. Let's jump in. Let's talk about this. I want to go to an article by Smart Asset. They talk about how to avoid 5 common retirement tax traps. And the first one is avoiding taxes on real estate sale. And this is what's trapping many of us in our homes. But there's also 4 other tax traps that I think it's important that all of us know about. So let's talk about the first one, which is what the thumbnail, what the title of this video was about. And that is the home sale capital tax exemption. And so that's the first one. One such tax break is the home sale exclusion, which allows individuals to exclude up to $250,000 or $500,000 for a married couple of gain on the sale of their home. Now, this exclusion only applies if we've lived in our home for at least 2 of the last 5 years. If we've lived in it less than that, we don't get that exclusion. I should say I'm not an accountant. I just want to put this on your radar screen. So what's happening is many seniors are looking and saying, I'd like to sell my home. I'd like to downsize, but I'm going to get hit with a big tax, and I don't want to do that. And again, I'm not an accountant, but for many of us, if we pass away with our home, then our heirs are going to get a step up in basis. So this is tax that, once we pass away, our kids or whoever our heirs are going to be, likely they won't have to pay any tax on that because they'll get what's called a step up in basis. Again, not an accountant, just want to put it on your radar screen. But the tax on our home, the gain on our home can hurt us in other ways as well. Another one, and this article talks about this being a continuing trap for retirees, and that is the possibility of taxation of Medicare. Not really taxation, but what's called what I call a premium on premium. What the IRS, what Social Security calls IRMA, which stands for Income Related Monthly Adjustment Amounts. And essentially, it's an additional premium on the premium that we're already paying for Medicare. And it looks back 2 years and looks at what our income was from 2 years ago. And so as we're approaching retirement, not only can we get hit with the capital gains tax, but now we could start paying more for our Medicare premiums, at least for a couple of years while that's still on our record. So how we deal with Medicare is incredibly important, and that's why I'm proud to partner with today's sponsor, its Chapter. They provide expert Medicare advice for free for consumers, for viewers like you and me, and help us make good decisions when we first get on Medicare, as well as each year that we re-enroll. They're not going to help you with the tax things. They're not going to help you with things like IRMA, but they are going to make sure that we're on the right plan, which is really key because according to Fidelity Investments, once we reach the age of 65, our healthcare expenses for the rest of our lives cost above and beyond what Medicare is going to cover is $165,000 per person or $330,000 per couple over the remaining of our lifetime. And unfortunately, no, that does not include long-term care insurance. So getting with an expert to help you make the best decision. Now, you don't want somebody trying to sell you something. You want somebody listening to what your needs are, listening to your situation, listening to what your goals are in retirement, and recommending the plans that are best for you, both initially and then each year as your life changes. Unfortunately, many of us are going to get different prescription drugs. So checking in each year makes sense. Again, you want an advocate for you. Let me read to you one of the comments from one of my viewers. Here's what they said in the comments section. They said, Chapter, pleasantly surprised. So I called thinking they would just try to push hard on some Advantage plan. The guy did not. He actually said that original Medicare and a supplement were the best choices. Not sure how he, chapter, makes any money off that advice, but their street cred sure goes up with me because I didn't get the expected car sales guy pitch. Their street cred goes up with me as well. I believe they're advocating for you in your best interest, and they're experts. You can reach chapter at this phone number here or by reaching out at this link or this QR code. Thank you, chapter, for partnering and sponsoring this video. Okay, let's go back to the article. The third hidden tax is Social Security being taxable. Now, before the big, beautiful bill passed, as I record this, President Trump just signed that into law, but before the big, beautiful bill passed, it was estimated that about 40% of us were paying taxes on our Social Security. Some or all, up to 85% of our Social Security was being taxed. Here's what the article says. The combined income, which is what the Social Security looks at, combined income, we need to know what this is. It's our adjusted gross income plus non-taxable interest plus half of whatever our Social Security benefits are. And the article says this about it. The limit remains unchanged in 2025. Since 2024, which is $25,000 if you're a single filer, head of household, or a qualifying widow or widower with a dependent child. And for people married filing jointly, the limit is $32,000. Above that, some or 50% or 85% of our Social Security can be taxable. Now, as I said, the big, beautiful bill was just passed. They've increased the senior deduction. And according to the Social Security Administration, they say now that only 10% of filers, when you take into consideration this increased senior standard deduction, they say that only 10% of us are going to have our Social Security tax. So that's good news. So avoiding tax on our Social Security. The next one is avoiding taxes on required minimum distributions. How do we do that? We do that by planning. And before I get there, there's a big one that people forget, and it has a penalty. I'm going to get to that in a second. But, how do we avoid required minimum distribution taxes? That's like when you take money out of your 401k or your IRA because you're a certain age, right? We didn't get taxed on that money when we put it in, and the IRS is saying, hey, at some point, you got to pay the piper. So they give us required minimum distributions, and for most of us, that's going to count as ordinary income. And the way you minimize that is by being strategic and thinking through the three buckets that you want to have as far as access to capital. We have the Tax Me Later account, which is what's subject to RMDs, the regular IRAs, the regular 401ks. Then we have the Tax Me As I Go account, which would be like your bank account, a taxable brokerage account at Schwab, Vanguard, Fidelity, places like that. And then we have the Tax Me Never account, which is the Roth IRA. So having those buckets set up, and the reality is many of us don't have our money split in the most tax-advantaged way. In addition to the cost for healthcare, the other big expense that retirees underestimate is their taxes. So getting that right has big implications. The way you get that right is you work with a fiduciary financial advisor. I know many of my viewers are never going to do that because of the cost or because they want to do it themselves. If that's you, I urge you, don't do this kind of stuff in Excel or Google Sheets. It's way too easy to make a mistake. It takes too much time. The software that I like that's designed for people like you and I is called Bolden. It used to be called New Retirement. You can reach it at this QR code or at this link. It's very affordable. It's very powerful. This video is not sponsored by Bolden. It's sponsored by Chapter. Again, Chapter, thank you. Phone number and QR code. Thank you for sponsoring it. But I am an affiliate of Bolden. So if you use that code, you'll be supporting the channel. Okay, and the last one here is the one that many of us forget is if we take a side job, if we're a freelancer, The IRS and taxes haven't been withheld. The IRS still wants to get paid and wants to get paid quarterly, so don't forget to do quarterly tax estimates. If you like this video, the next video of mine that you should think about watching is this one, which are 8 things to stop doing in your 60s in order to enjoy your journey when you get to retire. Thanks for watching this one. Bye-bye.